Welcome to As Real as They Come, Dallas. My name is Yulia Brown, and I have a very special expert guest here today, Mr. Justin Murch.
Hello.
Hello, Justin.
How are you?
Welcome.
Thank you.
So tell us about yourself a little bit. Let's get to know you first. Are you native to Texas?
Sure. So my name is Justin Murch. I'm the president of Creative Credit Solutions, the credit restoration experts, and I am not native to Texas. You will know that when I start talking that I talk a little bit fast. So I'm actually from Southern California, from San Diego.
Wow. And what brought you here?
So I initially came here to go to school. And then, like a lot of people in Texas, they get stuck. And then the market's good here, and they get a good job, and the cost of living's low. So you're like, maybe I'll stay.
It's Texas, y'all. Well, definitely welcome. I feel like I am a Texan myself, even though I'm not original, but it grows in you.
It does. It does.
It just grows in your heart, and you can't move anywhere else. So don't come to Texas if you're not ready to move.
And what's funny is my wife is actually native from Austin, and she sounds like she's from Southern California also.
Wow.
So she does not sound like she's from Texas.
Y'all meant to be.
Absolutely.
And recently you became a dad.
I did.
And so now you have a native Texan.
I do. Yeah, I do. Yeah. So I have three kids. I have an 18-year-old, I have a 13-year-old, and then I have a new baby.
Wow.
So I thought 43 was a good, time to have a baby.
It's a fine time, absolutely. And especially it keeps you young.
Yeah.
Keeps you going.
It's different, too.
Absolutely.
Very different.
So tell us about your company. Tell us what you do. And I know that people always think that they have so much resource on their credit scores, and there are so many outlets where you can pull the information from. But as you and I know, I'm in Linden, you are in the credit restoration. Basically, people are confused, and we know they are confused. Could you shine some light on it?
Sure, yeah. So my company's a full-service credit restoration company, and we help clients mostly in the mortgage industry get qualified. Okay, so and there is a lot of confusion. Okay, so first of all, a little bit about our services. What we do is we help restructure debt to help with debt-to-income issues. We help clients reestablish credit. A lot of times, clients have had their life issue, and they don't know, kind of where to turn. They have the drive, the means, and the ability to do something about their situation, but they're at a place in their life where they're just kind of confused about it all. So a lot of times they need to be steered to the appropriate levels of credit. In many cases, they have a lot of trauma on their credit profile. So they're going to have, late payments and collections and charge-offs. And where do they turn for all of that? Inevitably, the client's going to make wrong decisions that are going to impact their score negatively.
Life happens, for sure.
Yeah. And then also, they're confused because they're driven to credit scores that are really insignificant, that really don't matter. Credit Karma is, enemy number one, right? Credit Karma, CreditWise, Credit Sesame, those are all what are called Vantage scores, and they have nothing to do with the mortgage score at all. I mean, I can't tell you how many calls a day that I get. Well, I have a 640 on Credit Karma, the lender pulled my credit, and how my credit's destroyed, and I'm pulling a 550, and that has nothing to do with it at all. It has to do with the fact that you're looking at the wrong scoring model.
Wow. So average consumer, and I'm guessing at least 95% of people out there on the market or even in business are convinced that there are three credit scores: your Equifax, your Experian, your TransUnion. But are there just three credit scores out there, or there's more?
No, so there's actually hundreds. There's hundreds and hundreds of credit scores. So and it's gotten less complicated over the years because there's been lots of lawsuits by the federal government to kind of minimize some of that. A decade ago there were many different models. Right now it's down to really two basic players. There's Vantage Score and there's FICO. But there used to be what are called informational scores that the credit bureaus would actually highlight for consumers, right? So the informational scores, and in fact, Experian got sued many years ago for this very thing because they were showing scores that really didn't have any impact at all. No lender used them, and then kind of making it look like it mattered, right? But it was really just to drive them to their website. It's the same thing that Credit Karma does. It drives consumers to their website, and it's a free service, and it's a free service because they're going to sell you stuff on their website, right?
Like Credit Karma,
right.
Harvest your information. sell it
absolutely.
to everyone else, and then you wonder why you got these phone calls.
Right, right, absolutely. They're there to sell you stuff. There's no such thing as a free lunch. There is definitely no such thing as a free lunch. You're going to get what you pay for, and Credit Karma's cost $0. They represent TransUnion and Equifax, but they don't even have Experian, which is one of the the bigger credit bureaus. So they've got 2/3 of the information. They've got a credit score that is completely legitimate. It's a legitimate credit score. It's just that no lender in the mortgage industry will use that.
Wow.
So it's not like, I mean, it's harsh to say that it's a fake score because it's a real score. It's just not used.
So the algorithm, whatever algorithm they're using, it's not applicable. It's like trying to get a house loan but going through a auto company.
Right.
It's- It's not visible, and they're not going to use each other's scoring system. You probably have more chance about auto loan using your information from your FICO than vice versa.
Right, because it's more widely used. Now, there are people that are using the Vantage score, and they're starting to increase. But so here's kind of, and we can talk a little bit about how the scoring algorithm
Yes.
works. So a lot of people think that the credit bureaus are the ones that originate the information, okay? Indeed, they're big databases, and they each keep all of our personal information on their databases, but they don't originate the credit score. The credit score is derived from a separate independent company. So, as an example, FICO. FICO is a separate independent company, and they've been around forever, right? They've been the longest standing algorithm out there to be predictive in the ability of a borrower to pay back money. But what they do is they actually put their algorithm, which is just a mathematical computation, over each one of the credit bureaus, and the unique information that's there, and it spits out a number. And that number is supposed to be telling us to the consumer's ability to repay money. Okay, so FICO's a separate company. Vantage Score, Credit Karma, CreditWise, Credit Sesame, all of those, is a separate company. And here's a little tidbit of information. Vantage Score was initially created by the credit bureaus, which is kind of funny, right? So think about it. The credit bureaus didn't want to pay FICO for their score anymore. They wanted to control the flow of information, your data, and also the credit scores. So the three of them came up with a joint venture, and they came up with Vantage Score. And ever since Vantage Score came out, there's been lawsuits between FICO and Vantage constantly because they're trying to jockey to get position. So Vantage Score pulls credit scores anywhere in the neighborhood of 13 to 15 billion times a year. FICO does 11 to 13 billion. Credit bureaus just didn't want to continue to pay FICO for something they felt they could do better, right?
Do better.
Right.
Wow. So let's talk about credit algorithms. What's involved in that? Is it your ability to repay? Is it good to pay off your credit cards right off the top? Or please tell us.
Yeah, so there's lots of different aspects, okay? So the main thing to realize is, yes, there's hundreds of scores. We're going to focus on FICO for our talk because, we want to dig into what that looks like on the homeowner side, on the lender side, for realtors and for people that are trying to purchase a home. So within FICO, there's dozens and dozens of scores. Okay, so let's kind of capture that. So there's hundreds of scores, Vantage scores, and then within FICO, there's dozens and dozens of scores. So consumers, think about how confused
It's like
consumers
a rabbit
are.
hole.
Yeah, so they're like, well, wait a minute, that is my FICO score. Well, no, it's really not, though, because what you're trying to do, if you're trying to purchase a piece of real estate in the mortgage industry, they're going to use what's called FICO 2, 4, and 5 on the mortgage score side, and that's very different than what you're looking at, which is most likely going to be your FICO 8 or FICO 9 score. Does that make sense? So
That makes perfect sense.
So each industry pulls its own variation of FICO based on the risk within that industry. So your mortgage industry is going to have a very different level of risk than your auto loan industry, which is going to have a very different level of risk than your bank card industry, which makes sense, right?
It makes perfect sense.
Right. And the mortgage industry is going to be your highest level of risk. Your FICO is trying to determine the propensity for a borrower to pay back money over 30 years, $100, $200, $300, $400,000. It's not like an auto loan where they're essentially giving you a collateralized loan. They're giving you a vehicle, and if you don't make payments on that vehicle, they just come pick it up, right?
Yeah.
So they can repossess the asset. They can give you a high interest rate on the auto loan side if you have poor credit. So they can mitigate risk in a couple of extremely tangible ways, which makes that industry low barriers to entry. Anybody with a pulse and an income can get an auto loan, even with the repossession or problems. Now, the mortgage industry is not like that. Any series of things can cause a borrower to not be qualified. It's not just people that have had a lot of trauma, just some things that have happened in the recent can cause you not to be qualified.
Absolutely. One missed payment within 12 months that
Right.
can haunt you for quite some time.
That's right. Or serial late paying. That's the thing also, you know. So somebody may not have terrible credit, they don't have collections and charge-offs, but they have a history of paying late.
Maxed cards,
Max credit cards.
that will drop your score like no other.
Right.
I love that website that Justin provided us with once we signed up with his program, because whether your credit is decent, good, fair, regardless of your situation, it's always good to monitor your credit and
Absolutely.
see what affects. And it's interesting to watch. It's like, oh, your new balance is this, so your credit score is this. It's like,
Or your
Wait a
actual,
minute.
yeah, your actual credit score.
your actual credit score.
Right.
And it's wow, that's
Right.
really impressive. So let's talk about algorithms.
Let's talk about the credit score. And so, since my company is mostly deals with mortgages and lenders, quite honestly, we're going to focus on the FICO algorithm, the mortgage score, okay? So, as I mentioned previously, there's dozens and dozens of scores, even within FICO. Each industry pulls its own variation based on the risk assessed to that industry. We're going to focus on FICO 2, 4, and 5, and this is how lenders will determine if a borrower is qualified. So what they do is they pull a number, they pull a credit score from each one of the credit bureaus, and each one has either FICO 2, 4, and 5 on each one of the bureaus, and whatever lands in the middle is going to actually be their mortgage score. There's some confusion. People think that it's the average of their scores that the lender pulls, but that's not so. You can have literally a 750, a 650, and a 640, and 650 is going to be your mortgage score. Okay, so we're going to talk about some things that go on with the mortgage score. The first thing that we're going to talk about is going to be inquiries. Okay, and I hear so much about the inquiry. The reality is that when your lender pulls your credit, it's really not that big of a deal, right? Unless you're one of those people that pulled your credit 18 times last month, right? Then it becomes a big deal, right? It's 10% of your score. In general, 3 to 7 points is what it's going to cost you. But the reality is that there's kind of some differences. The first is that FICO gives you a 30-day grace period, so you're not going to see that impact for 30 days, okay? And then also, within similar industries, you're allowed to pull your credit as many times as you'd like. So, as an example, if you go to that auto dealership, and I hear this all the time from my clients, and they pulled your credit 16 times, they're like, it made my score crash. Well, the truth is that in the auto loan industry, they can pull your credit as many times as they'd like to within a 45-day period, and it only accounts for one pull. So yes, you'll see it on your credit report, dozens and dozens of pulls from that auto dealership, but it's only going to impact you once. Make sense?
Makes perfect sense.
Any questions about inquiries?
No, but I would like to make a comment too that a lot of people, when they apply for a mortgage loan, thinking, okay, my credit is being pulled, so I can do whatever I want with my credit.
Right.
And if for one reason or the other, which is very rare, your lender will tell you, do not pull your credit, do not try to buy furniture, do not
Yeah,
try to buy an RV,
Absolutely.
a boat, whatever. Especially if you're buying things during, like buying your house during the holidays, all the sales happen around the holidays. So with that said, you're basically thinking that this is the best deal on furniture I'm gonna get, and I'll get it into my new house. Well,
And I'll put it on my credit, and I'll put it on a brand new credit card.
and I'll put it on my
0%
brand new
interest.
credit card. So what happens with that? Lender will pull your credit towards the end of the deal before we close to make sure that there are no new credits, there are no new inquiries. And if there are new inquiries, we need to know if there are new lines were opened. And that's what messes with the closings. I can't tell you how many deals we had when we had to actually turn down the whole transaction because somebody bought a new boat. It's
Right.
just, it's devastating because you're ready to move, you have your mover scheduled 3 days before
bought a new boat.
closing. We
It's
can't
usually-
close.
Yeah, it's usually a vehicle. That's the one that I see the most.
The vehicle, the boat,
Yeah.
recreational vehicle, furniture, those are detrimental not to do. While, and don't change your jobs.
Absolutely. Yeah, don't change your jobs, right. Don't switch jobs. So if you're pre-qualified, Yulia's saying, do not do anything, right? And we
Nothing.
tell all our clients that too. We write it up in their contract. We say, do not pull credit, do not seek credit, do not do anything while you're with us, right? Because those things can really, mess up things, particularly in the loan process. Okay, so credit mix is going to be another 10% of your credit score. Typically, our clients have had some kind of life issue that has brought them to this place, and usually they need to reestablish credit. So in general, on the mortgage score, you really want to have 3 credit cards and 1 installment loan. The good news is that everybody has an installment loan, right? They all have their car or student loan, so that's fine. You'll see a lot of things where people do like self-lender and things like that, which really doesn't really help you. Where you're going to see the impact on your credit mix, and it'll also feed into utilization, is those credit cards, right? So there's lots of options. If you're a client that can't get credit anywhere else, there are options for you, right? You just have to know where to go to find them. So interestingly, we're one of the only countries where you actually have to take on debt to build out your score, right? I recently took on a client from New Zealand, and he thought our system was just crazy. He's like, so you mean I have to take on debt in order to show that I can have good credit and take on more debt? So that's just the way our system works. So 1 installment loan, 3 credit cards. Average age of accounts, this is going to be a metric that I usually go into a very long detail about. Obviously, the longer history you have, the higher you're going to score in this particular bracket, right? So again, people that have had the life issue, they're on the other side of that. They think that their average age of accounts is non-existent because maybe they have a student loan and they don't have any credit cards. Well, the truth is that with FICO, particularly on the mortgage score, it's your open accounts and your closed accounts that get figured into this. And there's a mathematical computation. It's pretty simple. You take all the months of all of your open and closed accounts, you divide it by the total number of accounts on the revolving side and on the installment side, and then you come up with a number. So clearly somebody who has got a 1 year or less average age of accounts is going to be a very thin credit profile. Somebody who's newer to the credit world, that's going to be high risk, right? Somebody who's got a 20-year history of accounts, 10, 20 years of history, obviously is going to be lower risk. And anything in between is going to be various levels of risk. So we want to try to get, people, people always ask, well, what's a good length of time? I would say, if your credit's perfect, 1 and 2 years works just fine. But if you have a thin credit profile and then you don't pay your car payment, your credit's going to be very low after that because your profile is thin. Okay, so credit utilization. Okay, now there's multiple areas to each one of these particular buckets, but we're not going to get into all the nuances of them. If you ever want to know more about how it all works, you can always call me. We can talk more about it. But so credit utilization in general, there's 5 different areas to utilization. Part of it has to do with your installment piece. Part of it has to do with your credit card piece. But we're going to just discuss the credit card piece because that's where your biggest push is going to come from. Okay, so FICO has determined that people that carry very high balances in proportion to their limits are higher risk. It makes sense, right? If you've got $20,000 worth of credit and you are maxed out, is that high risk or is that low risk?
It's definitely high risk.
It's definitely high risk, right? It's definitely high risk. Unless you got 0% interest, then... So is it really high risk if you've got 0% interest? Probably not, right? So in general, utilization, on the utilization piece, you want to stay below 8.99%. On the mortgage score side, it's under 8.99%. So if you have a $100 limit, you want to stay under $9. That's going to be the optimal area to optimize your mortgage score. You see a lot and hear a lot about the 30%, and that's also true, but that's the second best tier, right? Mm-hmm. And they've actually found that people that have the highest credit actually stay around 2 to 3%. Pretty much they don't carry balances. But if you carry no balance on your credit cards, the mortgage score will actually penalize you. So you need to carry a small balance. On-time payments, this is going to be all of the things that are negatively can affect you. It's going to be your 30, 60, 90-day late pays, your 120 late pays, your 150 late pays, your 180 late pays, right? And then after it goes 6 months without getting paid, it goes to charge-off status. And then ultimately it can get sold to a collection agency, and that's when those people start, anybody's ever had a collection, they're third parties that buy debt, and they're like maggots on the floor. They're going to harass you and call you and do all kinds of fun things to try to capture your attention. Okay, so after collection, it can go to judgment status. You can get sued. Luckily in Texas, there's not a whole lot of recourse here. After 4 years, the statute of limitation runs out. They can't sue you after 4 years. They can't garnish your wages here. They can't reach into your bank account and take the money out of your account. In Southern California, they can do all those things, right? So a judge has a judgment after you've been sued, they can garnish your wages there. But in Texas, we don't play that. So, My clients do unfortunately get sued at times, and I say, hey, listen, relax. They just want to get your attention. If you call them, they'll stop the court proceedings. And honestly, we don't get sued very much here because there's just not a whole lot they can do.
Absolutely.
If they look on your credit report and they see $200,000 worth of equity in your house, you're probably going to get sued if you burn Capital One for $5,000, right? But if you are somebody who's got like nothing on your credit report to substantiate getting sued, usually that doesn't happen here. There are exceptions, but Texas is a good place to live if you've had life issues.
So on average age of accounts, when you close your credit card, does that impact your credit right away, or?
That's a really good question. Okay, so and it's a loaded question. Okay, so I'm going to tell you, I'm going to answer that in a way that most people don't like to hear. Okay, but I'm going to tell you anyways. Okay, so if you have, let's say you have 4 credit cards, and your average age of accounts is 10 years between all 4 credit cards, and let's say they all have 0 balances, closing that one credit card is not going to impact you. Because remember, FICO, I know you don't want to hear that. Don't close your credit cards, by the way. We'll talk about that in a minute. FICO accounts for the open and closed accounts. Now, here's where we get into trouble, right? Somebody closes their credit card, and they have a balance that's on your credit card, right? Let's say they have a $5,000 balance on their credit card, and they have a $6,000 limit, right? So now they've closed that credit card and they've got no limit to substantiate the utilization piece, right? So now they're in the whole $5,000 because that credit card is closed and they get slammed here. So in general, don't close your credit cards, particularly if you're with me, particularly if you're in the home loan process. Do not close credit cards. But where you hear credit cards closing them causes a lot of problems is mostly on the Vantage Score side. The Vantage Score only accounts for open accounts. So yes, if you have one credit card and you go to Credit Karma to pull your Vantage Score and you close that credit card, you're done. Your score's going to plummet. But remember, FICO accounts for open and closed accounts. Very long answer.
But that's a great answer because, like you said, so many people are confused, and between
Right.
Credit Karma and so many sources of information, you really get slammed and you don't know what to do.
Right. So, and if you have, remember, 3 is optimal. 3 credit cards. So you don't want to. If you have 3 credit cards, you don't want to close that one because now you've got 2, right? For your first credit card, if you have none, you're gonna have to see a big impact. Your second's a big impact. Your third's a small impact. So, but if you have 4 and you close it and you have no balances on any of your credit cards, it doesn't matter. It doesn't matter in the short term.
So don't keep your credit cards at 0.
Right. Don't keep your credit cards at 0.
Don't close your credit cards.
Right. So you can't. So if you have 4 or 5 credit cards, you can keep 3 of them at 0, but just make sure you have a small balance on one of them.
On one of them.
Right, because the mortgage score actually will penalize you for having 0% utilization.
Because then they don't know what your ability to repayment.
Right. I don't know why they think that's high risk, but apparently it is. We're in the U.S. You got to have debt in order to look good. That's the way it works.
Wonderful. And let's get to your services. What is your perfect client?
So my perfect client is a client, and I've mentioned this, that has the drive, the means, and the ability to do something about their situation. And my company is a higher-end company, and we don't take on clients that can't be helped. I mean, literally half the clients that come our way cannot be helped in the short term. If they can't be helped in the short term and we can't find a short-term solution for them, then we're going to not take them on as a client. Some of the biggest myths in my industry are that anybody with poor credit can be helped, and it's just not true. It's just not true. Timing is really, really important timing is really important when it comes to a client. Also, there's another myth in our industry, and that's that people that have poor credit don't have money, that they're poor. That's not true.
Absolutely not true.
People have life issues. Most people's financial situation goes up and down over their life, and they may be down here. I mean, you might be a guy that was making $80,000 a year and COVID hit and you got laid off. Or your company consolidated and you got laid off and you had to take another job making $50,000 a year. Well, you were supporting your family at $80,000. Doesn't mean you don't have money. Now you've gotten your regular job back and now you're positioned to do something about it. So it's really about timing. It's about timing.
And you could be a doctor or a lawyer, somebody with a substantial income, and you may not have any financial trouble to begin with, but then you don't know things about your average account age and your utilization of the credit, how to mix and match to get that ultimate credit score. Yeah. So
Right.
It's a lot of different things.
Right, and it's also counterintuitive because people that, especially they've had the life issue and they've got a lot of collections, they think that paying those collections off is going to help their score, and the reality is, and you know this from being in the mortgage industry, it doesn't help your score.
It re-ages it at some point. So.
Yeah, it actually can make your score go down in some cases, but we need to get those negative entries removed from your credit, and there's actually strategy behind that. So the common person is not going to know where to start with all of this stuff. And the heavy lifting requires specialization. You know, you've got to know what you're doing in order to deal with collection agencies and charge-off accounts and the credit bureaus. You've got to know how to navigate those waters to get the best outcome. And it's like me trying to, you know, sell my own house or write up my own loan.
Oh, you mean internet won't tell you how to do it?
Yeah, I don't have the specialty to do that. I don't know the ins and outs of how everything works. You know, for us, we work with, you know, hundreds of collection agencies. We have a database of those we know who is what. We know who are the hard ones, who are the easy ones. We have a database of how it all works. So.
And so we're having our viewers, and where can they find you?
So you can find me at creativecreditsolutions.net, or you can call me directly, 972-603-6776. And if you go to a lender in the Dallas area, there's a good probability that you'll get outsourced if your credit's not quite where it needs to be, and we might have a conversation anyways.
Yeah. Reach out to Guaranteed Rate.
Yeah, Guaranteed Rate, exactly.
We'll get you all set up. Wonderful. Well, Justin, thank you so much for being our guest today, and thank you for this wonderful presentation.
Sure, yeah.
It was very insightful, and thank you, our viewers, for watching As Real as They Come Dallas. Please hit like, subscribe, and we'll be back with you next episode. Yay!